elements of accounting: income, expenses, assets, liabilities, and capital. And these first two, income and expenses. So income is the money which we are receiving, and expenses is the money which we are spending. So a business has two things. Business receives cash or receives money by providing goods and services, and during these activities business is spending money. Business is paying rent, business is paying salaries, is paying other expenses. So money coming in, money going out, income and expenses. And these two, when you put them together, it makes your first financial statement, which is called your income statement. So if you remember, we talked about two financial statements, income statement and the balance sheet. And we had 5 elements of accounting. With the help of the first 2 elements of accounting, income and expenses, we prepare our income statement. So in income statement, we collect all the income and we write down all the expenses. And what do we get as a result? We get profit. Profit is what? Profit is income minus expenses. Like if you receive $100 and you spend $90, $10 is your profit. So whatever remains within the business, $10 remain in the business, that $10 is your profit. And when I say profit is equal to income minus expenses, so which expenses? I only speak about OPEX here. We don't speak about CAPEX. We speak about OPEX, operating expenses. So first 2 elements of accounting, they help us in making our income statement. And the purpose of making income statement is to calculate the profit of a business, and profit is equal to income minus operating expenses. And this is called your financial performance. By the way, this is called your financial performance. So financial performance means the ability of a business to generate profit. So you say that last year our financial performance was very good, which means that last year we had a lot of profit. This year financial performance is not good, which means that this year we are not making good profits. So financial performance is the terminology which you need to remember. Then you've got the next 3 elements of accounting, which are assets, liabilities, and capital. And when you put them together, you make your balance sheet, which is also called statement of financial position. So 5 elements of accounting. The first 2, we make income statement, and the next 3, asset, liability, and capital, we make our balance sheet. So 2 financial statements. And for the balance sheet, our equation is asset is equal to capital plus liabilities. Now, this is something you need to understand in more detail. Assets are always equal to capital plus liability. For example, if you have an asset of $100, so capital means the money which belongs to you, and liability means the money which you have taken from outside. So let's suppose I want to buy a computer for $600, and when I purchased computer, I didn't have all the money. So what I did, I paid 400, and 200 I take as a credit, as I take a liability, and I promise that I will pay later. So my asset is 600, which is equal to my capital 400 plus my liability 200. So 600 will be equal to 400 plus 200. That's how balance sheet equation will always be equal. So what do you see from the balance sheet? What you see from balance sheet is how much are your assets? How did you finance those assets? Where did you get money to buy those assets? What are the liabilities standing against those assets? So my asset of 600, how did I finance it? How did I pay for that? I paid 400 from capital, which is my own money, and 200 I took as a liability. So that 200 is my liability. So 600 will be equal to 600. So the purpose of balance sheet is to analyze how much assets a business has and what are the liabilities standing against those assets. You know what? It is not very important to own the asset. What is more important to see how much are the liabilities standing those assets. How did you purchase those assets? You've got $1 million assets on your balance sheet. So it looks good. $1 million assets look good. But the second question is, where did you get money? How did you buy those assets? So you immediately see how much are the liabilities for $1 million. So you got asset for $1 million and you had liabilities of $300. So 700 was your capital, and this is what belongs to the shareholders. Or you can say that asset is equal to equity plus liability, This equation, equity, I would be discussing when we will do chapter number, I think 19, which is your company accounting. But here you should understand that equity is the money which belongs to the owners of the business. So equity is that money which is the shareholders' money. So if my assets are $600, the computer, how much I put in? 400, that was equity, and 200 was my liability. So we have two terms, financial performance and financial position. Financial performance, it reflects the income statement. Financial performance means ability to make profit. And financial position is the balance, is the relationship between assets and liabilities. And financial position you see from the balance sheet. So financial position means how much assets and how much liabilities do you have. That is called financial position. The objective of financial statement, let me read it out for you. To provide information about the financial position, which means the balance sheet, the financial performance, which means the income statement, and changes in financial position, it is related to cash flow of an entity that is useful to a wide range of users in making economic decisions. Yes, because there are different groups of users. Groups of users means employees, one group of user, shareholders, another group of users, suppliers, customers, tax authorities, other government departments, investors, future investors. So there are different group of users, and they need information from a business to make some decisions. Like suppliers, they are to this business or not. So how would they make this decision? They will see financial statements and they will understand the information and then take decision. A bank, you apply to a bank for a loan, and the bank has to take decision, should I give this business a loan or not? And if I give loan, how much I should give? So how would bank take that decision? So bank would ask you to show you your financial statements. They will see your financial statement, your income statement and balance sheet, etc. Based on that, they would understand your business situation, and then the bank would decide that they are going to give you a loan or not. And if they are going to give, how much should be the amount, the period, what should be the interest rate, what should be the terms and conditions. So therefore, the purpose, the objective of financial statement is to inform the different groups of people about the financial performance, about financial position and changes in financial position, and so that they can make or take economic decisions. This is the objective of financial statements. Now comes purpose of financial reporting. So financial reporting is a way of recording, analyzing and summarizing financial data. I have explained it. Financial data is the name given to the actual transactions carried out by a business, example sale of goods. We already have discussed that. And financial in the books of prime entry. Yes, we will discuss books of prime entry are your journal where you write down your debits and credit, and this is the process of bookkeeping, the first stage in the accounting. And transaction in the books of prime entry, and the totals are posted to the ledger account. This is our chapter number 4. We will be doing our debits, credits and ledger accounting. The transaction in the financial statements, yes, this is the second part of the financial accounting process. Remember bookkeeping and reporting. So reporting is that summarizing. Types of business entity. So what is a business? Now if you see the definition of business in any dictionary, probably in Oxford Dictionary or whatever, it would say that a business is an activity which is taken up with an intention to make profit. So when you are doing business, the purpose, the objective of business is to make profit. So this is the definition of business, and a business is whatever size or native it has to in order to exist, it must make profit. And profit occurs when income exceeds expenses. Yes, income minus expenses. If income is more, there will be profit. But if expenses are more, there would be a loss. So what type of business entities do you have? We already have discussed before sole trader, partnerships and limited liability company. I've already explained that earlier. A limited liability company has a separate legal entity from its owners. I explained it, but let me tell you what it says, separate legal entity. It means that a company can purchase asset in its own name, it can sell assets in its it can make contracts in its own name. So it's an entity, it's just like a human, just it is not breathing, but it will do all the activities, and it has a perpetual life. The most important is that a company has a perpetual life. Sole trader, there is no company. So if the sole trader dies, the business is finished. But in company, the company exists. Like if you the company Coca-Cola, it has been operating for 200 years. So many shareholders, owners, they came and they died, they lived, they died, but the company stays because the company has an unlimited life. The company only dies when it goes bankrupt, when it is closed. So users group, what are the different user groups? We've got managers of the company, shareholders of the company, trade contacts, providers of finance to the company, taxation authorities, employees of the company, financial analysts, advisors, government, public, etc. So what type of information do they need? So this is one question we will do. Discussion question, it says, what information would these user of financial statements be interested in? Like investors, what are they? Financial statement. So remember, you've got same set of financial statement, one income statement, one balance sheet, but different group of people, they see it differently because their objectives are different. They are looking at different things within the financial statement. Not all of them, they are looking at the same thing. They are looking at the different thing because they have different questions in mind, and they have got different, expectations from the business. So they ask us what they are looking at, like investors and employees. What investors are looking at, what employees are looking at, what lenders are looking at. So they have a different perspective. So let's discuss them one by one. For example, investors, what they are looking at. Investors are looking at the profitability of a business because they invest money. So they want to know how much the business makes profitability. Future prospects, if the business will grow in future or not. Likely risk and return because their money, their investment is inside. So what risks are business facing? If the business is very risky, their money will also be in a risky business. So they may want to avoid it. And chance of capital growth. Capital growth means the increase in the value of share, the increase in the share price value. So if they put money and they purchase a share for $10, so what is the possibility that share price goes up from $10 to $12? And ability to pay the dividend. So will the business be able to pay them dividend or not? Because this is what they are interested in, really. Employees, what they are looking at. So employees are not looking at risk. Employees are not looking at dividends. Employees are not looking at capital growth. Employees are looking at profitability. Because a business is profitable, the employees can get salaries, they can get bonuses, they can get pay increase, etc. Long-term growth in the business. If they stay in the business, if the business will grow, they will also grow. If business is not growing, they will not grow. Security of their job. What are the prospects that they will remain in the job for a longer period of time? And then likelihood of bonus if they could get anything at the end of the year. And then number of employees. Is the company bigger or smaller, etc. And the ability to pay the retirement benefit, some kind of pensions, etc. Lenders. People who give you the money, what they return on finance will continue to be met. Return on finance means the interest. So if they have lent you some money, if they have given you some money, they are expecting interest on that. And if the business is able to pay interest or not. And other providers and security of their debt. And lenders are always interested that if we are giving this money, the loan to the business, if this business has taken loan from someone else also or not. Because if the business is taking loan from many different lenders, it means there's a lot of risk because a lot of people are expecting money from the business and the business is paying a lot of interest. So the lenders are always interested in seeing whether you can pay back the money or not, and what are your other liabilities. So it should not happen that if a business is bankrupt, there are hundreds of people standing at the door waiting for their payment. So I wouldn't give money or invest money or lend money to a business where there are so many other lenders as well. So lenders are looking at three things: interest payment, principal payment, the actual amount comes back, and who are the other lenders. Then comes suppliers. What suppliers are looking at? Likelihood of payment on time because they give you goods or services on credit, and now they want to see that if you would be able to return back to pay the money at the agreed time or not. and whether they should continue to supply or not. So this is like, they also have to see your just payment ability of their invoices and etc. They are not interested in your growth, they are not interested in your other risks, they are not interested in your dividend paying capacity, number of employees, etc. They are not. Customers, ability of entity to continue supplying, because sometimes you have customers where you make long-term contracts and your customer starts depending on you for the supply. So for example, I'm a factory which so for example, I supply raw materials to some factory. The factory wants to see my capacity, if I would be able to supply them continuously or not, because if I stop the supply or if I'm not capable of supplying the raw material, their operations, their activities will stop. So therefore the customers, they always want to see your capacity, that will you be able to provide to supply the goods at time or not. And profitability as a measurement value for money of goods bought, and they want to see that how much profitability is there and what is the value for the cash or money which they agree with you. Governments and their agencies. So governments got different agencies, statistics they want to see, size of the company, growth rates. This is the government issue. They want to monitor the businesses so that they can find out what is happening within the economy. So how much people you are employing, how you are growing, how much taxes you are paying, how much is their import export, and etc. etc. Public at large, individuals, the public. Contribution to local economy. How does the business contribute to the local economy? Is it having a positive impact on the society, a positive impact on of the local economy? Many businesses who are doing some kind of harmful activities, harmful for environment, harmful for society. So individuals, the public at large, they are watching those businesses. Information about trend, the prosperity of the entity and range of activities provided, what type of services, what different type of services and goods we are supplying. So this is the interest of within the public. Sometimes you may find your future or potential investors. So these are the different user groups and they have their own specific needs, and when they see the financial statements of any business, they see the financial statements, read the financial statement, understand the financial statement from their own perspective. So so you may get a question in exam from this topic. They will give you one user group and they will ask you that which one of the following information they match the need of certain user group. So you may find one question from here. So you have to read the book and you have to do some practice questions. We also will do practice questions together on